Right, good evening, everybody. We're just waiting a few minutes while people filter into the room, but thank you very much for joining us today. It'd be great if people could put a little note in the chat just to say that you can see and hear me and John. And I'm just going to, and that you can see our slideshow so we know you can see what's happening here.
All looks fine from my side, Neil.
Fantastic. And good evening, Samantha. Somebody's given us a little wave, so that's brilliant. Thank you very much. Okay, so yeah, brilliant. We're getting lots of raised hands now, so people can obviously see and hear us. Well, we'll start things off because we want to try and get this in within the hour because I'm conscious everybody probably wants to have their dinner, much like me and John probably do, and I'm not very good when I'm hungry, so we shall get started and crack on. So basically, thank you all for attending tonight. The purpose of this webinar is essentially to tell you about something called the Renters' Rights Bill, which is coming up as of next year. It's going through Parliament at the minute, and I'll come on to that. But essentially, as a letting agent, which is my company, Charles David Casson, and I know we've got some of our existing clients on tonight, and we've got some people we don't know, as well as even I've had a look at the list and we've even got some other letting agents on. So that's really nice, and people are obviously interested in the content. But Charles David Casson, we are we're an estate and letting agency based in Chelmsford, and we manage properties all over Essex, particularly Chelmsford, Colchester, and Basildon and the Billericay area. So kind of up and down the A12 and A127 corridors. And really, we do sales, but we also manage hundreds of rental properties, both single lets and HMO multiple occupancy properties. And what we want to do tonight is kind of come at it from two angles. One, as a letting agent, keeping you compliant as a landlord, making sure you avoid fines, and keeping as much of your income as you can and maximising your income from your rental properties. But also, we've got John with us tonight, who is a tax planning specialist and has sort of joined forces with us at Charles David Casson to sort of partner up to help our landlords to keep more of their rental income in their pocket at the end of the day. So thank you for joining us as well, John. So I'm going to talk a little bit about the Renters' Rights Bill first of all, and then I'll hand over to John for the tax planning kind of section. And please feel free, any questions you've got, if you put them into the chat, me and John will monitor them. And as I say, we're going to try and keep this on time, so we'll answer as many as we can. But if we don't get round to answering them all, please do still put them in the chat, because we'll be sure to note those and come back to you individually as well. So I've sort of told you who we are, but we're an award-winning letting agency based in Chelmsford. We've been in the Best Estate Agent Guide a couple of times. This year we were really proud to win some Esther's Awards, and the reason we're really proud of those ones is because they're actually voted for by our existing clients. So they're real genuine awards, and we're really sort of proud to win awards like that. Now, I've given presentations in the past, and normally actually sort of a physical presentation in front of a room of 60, 70 landlords. And I think we'll probably get back to that next year, doing physical events as well as these webinars. But tonight I'm focusing on a piece of legislation that's coming up. But I think it's just important to reflect that there's already over 170 pieces of legislation that go along with the private rented sector. And so things are getting a lot more complicated. They're already kind of complicated enough as it is for landlords. But they're certainly going to get more and more complicated. And I kind of want to give you an overview of what's coming along and also what some of the solutions to that are. So let's talk about the Renters' Rights Bill. So what is this? Well, first of all, to say it's not law as yet. It's currently going through Parliament, and it was actually brought to the table by the Conservative Party under a different guise called the Renters Reform Bill. and they didn't actually get it through before the end of Parliament. And then when we had the election and Labour were voted into government, they have sort of really championed this and started it again. And they're pushing it through at a really, really sort of fast pace. So it's currently at the report stage of Parliament. So it's already had 2 readings within Parliament, and essentially it will then go on through another couple of stages before then being heard in the House of Lords and then receiving royal assent. But Labour hope to have this in place by the summer of 2025, and kind of all of the sources and industry bodies we're members of and speak to are pretty confident that that actually will happen, and this piece of legislation will come into force now. And it is going to be the biggest change in the private rented sector for decades. It's a big step change in. We had the tenant fee ban back in 2018, I think, and that changed a lot of things for landlords and agents. But this is going to change the whole way tenancy agreements are structured, everything to do with how the private rented sector operates. So we'll kind of talk through that in some more detail. And there's 230 pages in the bill, so we're not going to get through all of it tonight, but I'm going to talk about kind of the headline stuff, the stuff that's really important. And then if anybody's got any specific questions or other queries, obviously we can deal with those later as well. So what's happening? What's the Renters' Rights Bill aiming to do? Basically, they want to abolish Section 21, which is also known as a no-fault eviction. So at the minute, landlords can serve a notice, get possession of their property back in a fairly straightforward manner, as long as all the paperwork's in order and the notices are served correctly. And part of the Renters' Rights Bill is that they want to abolish Section 21. They're also going to abolish fixed-term tenancies, so no more fixed 6 or 12 month tenancies. Every tenancy is going to convert to a periodic tenancy, so we'll talk some more about that. There's going to be a ban on taking payments in advance from tenants. We're also going to have tenants having the right to request pets, and landlords can't unreasonably refuse it, so we'll talk about that as well. Rent increases are going to be able to be more easily challenged at the first tier tribunal, so those are going to have to be dealt with differently. The Labour government want to put a ban on bidding wars, so we have got a supply and demand imbalance, and ultimately all of this legislation is really kind of contributing to that. But what they're trying to stop is people paying more for a property than it was advertised for. And then finally, we're going to talk about there's going to be a requirement for all landlords to register on a national database, so nobody can hide away anymore. And also the introduction of a private sector landlords ombudsman. So landlords themselves will have to actually be regulated as such by an independent body. There's also something called AWAB's law, which I'll talk more in detail about what that relates to. Something that goes along with the social housing sector at the moment, but it's being brought into the private rented sector under this bill. The introduction of a decent home standard, so there'll be a minimum standard of quality in rental property, and also tougher powers in relation to discrimination. So, people not blanket saying no DSS tenants, no children. There absolutely can't be any discrimination on the grounds of, quite rightly, race, age, anything like that. But really, they're trying to deal more with, I guess, discrimination that flies under the radar at the moment in terms of particular demographics of people. So let's go through a few bits in a bit more detail. So yes, abolishing Section 21. So they want to remove no-fault eviction. So as I said before, at the moment, we currently have something called a Section 21, where as long as we've served the correct documentation on the tenant at the right time, we can serve a Section 21 and not give the tenant a reason for wanting possession of the property back. And that this can't be contested. Tenants don't necessarily always move out because of Section 21. Sometimes they need evicting, but they can't actually contest the Section 21 because it's a no-fault eviction. So landlords are going to have to start relying on Section 8. which is a fault eviction, and it's actually giving tenants a reason why we want to remove them from the property, or why we want possession of that property back. Now, obviously, to do that, the government are having to strengthen the grounds for possession under Section 8 because there are genuine reasons why landlords will want their property back. So there's actually they're increasing it to 25 mandatory grounds, which means if you satisfy one of those grounds, the court has to grant possession, and 11 discretionary grounds, which means the court will take a view on whether to grant possession because of that. But the important thing to say here is you will still be able to obtain possession for legitimate reasons. So there is no panic on that. There's a number of reasons why you'll be able to get your property back. I can't, as I say, there's 25 mandatory grounds, so I can't put them all on the screen. But the reason I sort of screenshotted these ones in particular was the first two there. If the landlord or a family member wants to move back into the property, you will be able to do that. And the same if you want to sell your property, you will be able to do that. You can't do that within the first 12 months because the tenant's going to have a protected period of tenancy, which I'll come on to in a moment. And you will need to give 4 months notice in order to do it. But you will be able to get possession of your property back for those things. The interesting thing is, I think initial conversations I had with a lot of landlords have been, and quite rightly, actually, sometimes circumstances do change, don't they? We have a situation where we might be thinking of selling a property, and then circumstances change, and then we want to re-rent it again. Or we may have had a family member that wanted to move back into it, and then that changes for whatever reason. But the government are closing those loopholes, and there are provisions within the bill that if you evict a tenant because you want to sell the property, you then won't be able to re-let it for a certain period of time, I think probably 12 months. So again, all the detail is being kind of hashed out at the moment, but it's just important to realise there will still be ways to get possession of your property back. We just have to do things properly. So moving on to abolishing fixed term tenancies. So yeah, basically they're going to change all the tenancies to periodic. So at the moment we have fixed term tenancies, 6 or 12 months is sort of the norm. And then if the tenancy is not renewed, it becomes periodic. A lot of people call that a rolling monthly basis, and the tenant can give a month's notice at any time. What the government are proposing is to change that so everything becomes periodic. And interestingly, normally when they introduce new legislation, you tend to find they introduce it for new tenancy starting, and then they have a sort of a date in the future that the tenancies that already exist will come into that new piece of legislation. But on this one, they're actually proposing that whenever this bill comes into force, they will convert every single tenancy we have into a periodic tenancy. Which, of course, the worry there for landlords is that does mean tenants could give notice on day one of the tenancy, or as soon as this law comes into place. But I think the important thing to sort of mention and discuss with clients is that why would they actually leave? Tenants have, generally it's cost them money and upheaval and everything. They've moved their life once to move into a property. So the only reason they're really going to leave in a short period of time is if the property is in disrepair, it's not maintained, and they're not treated very well. So, as long as we are providing quality rental accommodation, it's being maintained, we shouldn't see masses of tenants just chopping and changing property because there wouldn't really be too much reason for that. Tenants will get a 12-month protected tenancy to start. So in effect, tenants are actually getting themselves a 12-month fixed tenancy anyway. It's just they can leave within that period if they choose to, but the landlord wouldn't be able to get them out within the first 12 months unless they were breaching multiple obviously conditions of the tenancy. Now the other change is going to be, at the moment in a periodic tenancy you have to give 2 months notice. That's going to increase to 4 months notice, but interestingly the tenants are going to have to give us as landlords 2 months notice. That's actually a bit longer than they're required to give us at the moment, so it's not all bad. one of the major things that's changing is how rent arrears will be dealt with, and this is something we've really got to kind of focus on and plan for. Um, so currently, tenants, in order to evict a tenant for rent arrears, they have to be 2 full months in arrears. So essentially a month and a day, because obviously the rent's always due at the start of the month. But they have to be in 2 full months rent arrears at the point of the possession hearing. However, you can serve a notice currently when they're in arrears for sort of 14 days or more. You could serve that notice, but when it gets to the possession hearing, they'd have to be 2 full months in arrears. That's going to change and actually lengthen, unfortunately. So tenants will have to be in 3 months arrears, both for the notice to be served and at the time of the possession hearing. We're going to have to increase the notice period to 4 weeks. The idea behind this is that the government is saying it would give tenants longer to kind of bring their finances in order, et cetera, et cetera. But it's not very helpful, obviously, for landlords who've got mortgages to pay, etc. So there is a discretionary ground on the Section 8. The proposed new Section 8 will have a discretionary ground for repeated arrears. So if you have a tenant that's constantly late with their payments, you would be able to take them down that legal route and look to evict them for rent arrears. But it is a discretionary ground, and the court would obviously take a view on that at the time. But really, proper accounting records of the rent is going to be absolutely essential, because the systems we use can tell us in real time what the arrears are, etc., etc. We time date stamped audits for kind of everything, when the rent's received, when it's paid out. So we can report on that very easily and produce rent statements. But if you're managing property yourself, obviously that's a lot more difficult. And if you've just got bank statements, you've got to put all that information together. You kind of need to start planning for that and how you're going to do that. The interesting one is payments in advance. The government wants to stop landlords taking 12 months in advance, 6 months in advance, whatever the case may be, from tenants, which it's not actually a very good thing for tenants. It actually could exclude many tenants types. We often have people who potentially have been through a divorce and have sold a property, and the only way they can meet the affordability criteria is to pay 6 or 12 months in advance. Of course, if you're letting a property which is an area where perhaps, particularly university towns and things like that, where you've got foreign national students coming over, sometimes the only way they can qualify is to make a payment in advance. It's absolutely not good for student lettings. It's not good for people with any adverse credit who, might be a sort of a decent person, but they've got some adverse credit and therefore they don't qualify through the referencing criteria. You just simply won't be able to take a payment in advance. So really, it's going to be a lot more selective in who can be accepted as a tenant. And I think the use of guarantors is going to become more of a commonplace thing. If somebody can't quite meet some of the criteria, then looking at a guarantor is going to become essential. And maybe even, we may even see a time where we want a guarantor for sort of pretty much every tenancy, because of all the changes that are happening, just to give extra security. But interesting, a lot of this legislation they kind of think is a good thing for the tenants, but actually the sort of the flip side effect of it is putting letting agents and landlords costs up. It's reducing supply in the market. It's actually excluding certain tenants. So it's probably it will end up driving the rents up further. But we could sort of probably rant about that for a long time. So I shall move on. The other thing I've mentioned is tenants are going to have the right to request pets. So that doesn't sound that major, but the reason it's being sort of headlined is that landlords can't unreasonably refuse. So at the moment, it's very easy. We've got a blanket no pets policy pretty much. Some landlords will say, look, I really don't mind, or I've got a country property and it lends itself to the tenant having a cat or a dog or whatever the case may be. But generally, most landlords don't accept pets. Now, I'm a pet lover, but I advise clients generally not to, because of simply the increased risk of damage. and we can't take more than a 5-week deposit at the moment. So what's the incentive for a landlord to accept a pet? But yeah, so under the new legislation, tenants are going to be able to request a pet, and landlords can't unreasonably refuse and must give a response within 28 days. So again, that's another sort of compliance job that we have to make sure we respond within the required time limits. We have to consider requests fairly and provide a valid reason if they refuse, and it's that's where that'll be where things evolve in what is unreasonable. Just saying potentially I've just put new carpets down, I've refurbished it, probably won't be probably won't be a reasonable reason to refuse a pet. But of course, if it was your home and you're moving abroad and you will be coming back to it, and you've got an allergy to dog hair or cat hair or whatever the case may be, then of course that would be a reasonable reason. So, it's just that we're going to have to really justify reasons for not accepting pets, properly document that, because tenants are going to be able to challenge anything they deem as an unfair decision through the new ombudsman, and then they will make a decision on it. The good thing is landlords are going to be able to request this is under the legislation, landlords will be able to not request, I should have put require, actually, that the tenant takes out a pet insurance. Obviously, because this legislation isn't actually officially enforced at the minute, we don't know what those insurances will look like. But that is a good thing, because we can only take a 5-week deposit. If there is a worry about a pet being in there for any reason, we can require the tenant to have a pet insurance, just to make sure, obviously, the landlord's property is protected. So moving on to rent increases. Now, basically, it's an interesting one, because the whole sort of thing behind this is that tenants are going to be able to challenge rent increases at something called the first tier tribunal. Now, actually, they already can do that. So the way we increase rent at the moment is either by agreement when we renew a tenancy agreement. Well, we won't be renewing tenancy agreements under this legislation because they'll all be periodic. So we'll be using something called a Section 13 notice. Now, at the moment, we give a month's notice, a minimum of a month's notice. In order to do that, we'll have to give a minimum of 2 months' notice under the new legislation. But tenants, although they already can challenge rental increases at the moment, it's very rare, to be honest. But this is sort of being headlined, so it may be that tenants think, well, I may as well, I'll take my chances and I may as well challenge the rent increase. And if they do, then the rent increase can't take effect until the first tier tribunal has heard it. And interestingly, at the moment, the tribunal can actually, if let's say the rent was £1,200, the landlord had asked for 1,300, and the tenant challenged it. If actually it was found out that the market rent was actually £1,400, then the first tier tribunal could award more than the landlord was actually asking for. So that's a bit of a disincentive for tenants to actually challenge them at the moment, where going forward, the first tier tribunal won't be able to award more than the landlord's requesting in the rent increase anyway. And they will be able to defer the rent increase by 2 months if they feel that it's going to cause the tenant undue hardship. So really, evidence is going to be crucial, storing comparables, etc. And that's where I think self-managing landlords will potentially have more risk exposure to this than clients that we manage properties for, because of course we've got a lot of access to data, not only Rightmove, Zoopla, but we've got the back end of those systems where we can not only see what's being marketed for rent, but we can see what's been actually let agreed and what prices they went for. We've got things like Data Loft, which tell us exactly the percentages that rents are increasing, etc., etc. So I think really both us and landlords are going to have to look at all of this data, justify the rent increases, and actually probably store that information somewhere, keep it as a kind of a pack, that if somebody does take you to the first tier tribunal, we can actually say, well, look, we've got all the evidence to say this is why we're suggesting that rent, and this is what the market's doing at the moment. So again, all of this there is a solution to, but we have to have the proper systems and processes in place in order to manage it. Just quickly, a ban on bidding wars. So again, we've got this supply and demand imbalance at the moment, and obviously quite often you might have multiple tenants looking to take the same property, and sometimes people will offer potentially over the asking price. Well, that's not going to be allowed. That's literally going to be banned, and the rent achieved must be whatever the property was advertised for or less. So I think what we'll probably end up seeing is that marketing rents may well increase slightly, in order, because we can't take more than it's advertised for. We may see that we actually start advertising properties for a little bit more, and then reduce them if necessary. Whereas at the moment, we generally put them on the market sort of on the nose, the best price we can get, and they let very quickly. And you may just see that people start asking slightly higher rents, and then obviously reduce if necessary. Just quickly, AWAB's law. Essentially, what this is a tragic case of a young baby boy. I can't exactly remember how old he was, but 3, something like that, who died in social housing. And it must be stressed it was social housing, not private rented housing, which makes it all the worse, really, because it's obviously social companies and councils that are responsible for it. But he died as a result of damp and mold. And so the AWAB's law has been brought in for social housing, but it is going to come into effect in relation to the private rented sector, which will basically bring new requirements and set out kind of requirements for people to address hazards such as damp and mold, and other things as well. So we just, a lot of damp and mold cases are caused by tenants not managing condensation properly, and there is no doubt about that. But just as the sort of the detail on this comes out, we may have to be looking at, just again, really evidencing what action landlords have taken so they don't become liable under this kind of legislation. And yeah, moving on to the landlord's ombudsman and database. So basically, at the moment, you can be a landlord and almost fly under the radar unless you're a landlord of an HMO that's a licensable property, or you're in a selective licensing area where you have to register. Now there'll be a national database that anybody renting out a property will have to register on that database. We don't know exactly what that's going to look like, but it probably will be similar to the licensing kind of regime that's out there in some areas already. The really interesting one is at the moment, only agents have to register with an ombudsman. So we're a member of a redress scheme, and only the agents have to do that. But there's going to be a new ombudsman established for private sector landlords, and so tenants will actually be able to take direct action against the landlord as well. And the ombudsman is there to basically say whether the landlord is in the right or wrong, as they do with the agent, and they can award compensation. But the compensation under this is going to be quite serious. It's £7,000 per breach, for each initial breach, and 40,000 or criminal prosecution for repeated breaches. So which, when I look at things like that, it makes me think our management fees at £2,500 a year aren't actually too bad, and they're pretty good value if we keep those fines away from our clients. But I think it's important to know this is really designed to drive out the rogue landlord. All of this stuff isn't designed to drive out people, good landlords who are providing quality accommodation, happy to maintain it, etc. This is really designed to drive out people who want to flout the rules, don't want to maintain their properties, and quite rightly so. So I think it's, again, it's not a panic, but it is a case of we've got to take this stuff seriously and make sure things are done properly. And basically, the whoever's governing this, the ombudsman, will be able to order a rent repayment order. So if somebody fails to join the scheme and then rents out their property, they could be then liable to pay all the rent back to the tenant. So and that is already the case, actually, if you don't license the property in a licensable area, or if it's an HMO that needs a license. So they're just now going to extend this to every landlord, that you must be registered with these things. So just to sort of wrap up, what can landlords do before I hand over to John? Well, as I say, don't panic. It's not aimed at good landlords. This is aimed to drive out the rogue landlords. And as long as you're doing everything properly, then there's, and you've got professional help, there's not too much to worry about. I think tenant selection is going to become, we're already pretty stringent. They go through a robust referencing procedure, but more time spent at the front end, selecting the tenant, making sure they're properly referenced, etc., is going to be absolutely paramount. Maintaining properties to a good standard, it's in everybody's interest. I think you can, if you do refurbish things, if you do give them a lick of paint, if you make sure they're maintained, you can get higher rents as they come up for reletting. But also, as I said before, why would a tenant move out after they've gone through all that upheaval, unless there's just multiple maintenance problems or an unmaintained property? So I think maintaining your properties to a good standard is going to become really important, to make sure there's less tenant changeovers. And I would say implement rent increases now. We're already doing that for our managed clients, but the process is a bit easier now, and we are seeing kind of higher rents. Actually, there is a national kind of figure out there that rents are starting to cool, and we've been seeing that in the higher end of the market actually for a while now. Anything sort of over £2,000 a month has cooled off. But I would just say let's review your rents now. Look at them now rather than wait till this legislation comes in. I think rent guarantee and legal protection policies is going to be a must for everybody, because you might as well have that peace of mind that you've got your legal expenses and your rent covered should a tenant fall into arrears. And really evidencing everything. I mean, that is already absolutely necessary, and we've got systems and processes in place that, as I say, all time, if a council came to us and said, "Our tenant reported some maintenance, you didn't do anything about it," we can click a button and say, "Well, actually, they reported it on this date at this time. On this date at this time, we sent a contractor to look," etc., etc. So we're protecting our landlords from those kind of complaints. And I think if you're managing property yourself, you need to start treating it like a business and have proper systems and processes in place, proper accounting, etc. But I think the self-managing landlord, DIY managing, is going to become more and more dangerous. Of course, you can draw up your own will, but is it a good idea? Probably not. You can, you could handle your own divorce technically, but would that be a good idea? Probably not. I think if you've got a business, most businesses have a group of professionals around them to advise them and help them, and that's really where your letting agent comes in for you, and that's going to become more and more important. So yeah, hopefully that's been useful. Hopefully everybody kind of took something from that. What we'll do is we'll move on with John, because I'm probably running a little bit over schedule, and then we'll try and tidy up with some questions at the end, if that's all right with everybody. But yeah, this is my contact details. What I would encourage you to do is like and subscribe our social channels. And if you go onto YouTube, we've got something called the Chelmsford Property channel, where we put a lot of landlord content and legislation updates and things like that. So if you subscribe to that channel, you'll see my face a lot more. And obviously get in touch with me there. My contact details on the screen, or if you're already a client of ours, you probably know how to contact me, or contact your property manager and they'll put you in touch with me. And one thing I would like to offer anyone, if you are managing your own properties at the minute, I'm more than happy to spend a little bit of time with you, having a look at, are you compliant currently? Will you be compliant going into this new legislation, and sort of give you some advice on how to maximise the returns as well. So please do get in touch with me on that. And of course, if anybody's looking to sell a property, we do a lot of that as well. So we can obviously give you valuations on those. Essentially, if you've got any property need, whether that's financing it, buying it, selling it, renting it, managing it, we've generally got a service for you. So just get in touch with us. So I'm going to hand over to John. There's just a few testimonials from some of the landlords we do manage property for. But yeah, thank you very much for listening. I'll pass you over to John, who can now talk to us about tax and being the most tax efficient you can be. So yeah, over to you, John.
Thanks, Neil, and good evening, everyone. Thanks for taking the time to be with us this evening. So, as Neil said, I kind of involved in the tax planning side of things, and was interesting. Obviously, we had the autumn budget, and although there were no sort of specific changes there that I could see for property owners in the budget, I think it's fair to say that the tax planning landscape is more harsh than it was prior to the budget. And I do find that more and more people are sort of looking at ways and means of saving tax. So we're going to cover some of that this evening. I probably need about 15 minutes or so, so hopefully we'll finish ahead of schedule. So just got a few slides to run through with you.
Oh, sorry, John. You need me, don't you, mate? That's my
I
mistake.
think I might do. Sorry. Okay. So clearly the emphasis is on helping people to reduce their exposure to tax, as well as doing tax consulting. I'm an independent financial advisor regulated by the FCA, and I tend to find that tax and financial planning tend to go hand in hand. Um, it is a holistic service and obviously taking account of each person's individual circumstances and needs. I don't necessarily have access to all of the solutions, which is why I work with accountants, solicitors, and estate planners. But what I do have is a number of opportunities to help people reduce their exposure to tax. And importantly, as you'll see there at the bottom of that slide, um, through Charles David Casson, together we're offering a free tax review service for anybody that would like to have a chat and take advantage of that. So in terms of the agenda, these are the usual taxes that I'm sure you're all familiar with. We're actually going to walk through each of those in terms of what the rates are and what the opportunities are for mitigating tax in these areas. And again, it's a bespoke service, so we're talking very generally this evening. But of course, everybody's circumstances are different, and depending on your circumstances and what you're looking to achieve, we'll tailor our advice accordingly. So just as a reminder, really, what the current income tax rates are, as you can see for yourself on the screen. The other thing that I haven't mentioned there is the fact that we tend to lose our personal allowance, that's the 12,500 at the top, once our own earnings go above 100,000. And we lose that allowance on a 2-for-1 basis, so that for every £2 above £100,000 worth of income, we lose £1 of the allowance. So effectively, by the time you get to 125,000, you've lost the personal allowance. So instead of probably paying 40% on that bracket, it's more like 60%. So what can we do to mitigate income tax? I've broken each of these taxes down into two sections. One is relating to properties, which is obviously of highest sort of importance and relevance to you guys on the webinar. I'm sure you're familiar with that option, setting up a limited company. In a nutshell, what are the reasons you might want to consider it? I guess the fact that you can offset your mortgage interest, and the fact that rather than paying personal rate of tax, which of course can be 40 or 45%, you can actually pay corporation tax on your company profits instead. So obviously that's a much lower figure. Um, Another thing to bear in mind, of course, is that if you do set up a limited company, there are costs involved. There are sort of legal regulations and accounting requirements, but may not be appropriate if you just have maybe one or two properties. But if you've got several, it's an option to consider. So the next one is income tax still, but non-property related. So we're really talking about other assets. And, it's interesting. Sometimes we forget we're actually liable for income tax on our savings interest in the bank. Maybe that's not the best place to have our money, partly because the rates aren't particularly great. And secondly, because we could pay up to sort of 40-45% tax on the income. So there are other ways and means of sheltering assets from income tax. We've got three examples here. Pensions, which I think most property landlords are not necessarily a great fan of, but there are good reasons for having a pension alongside your property portfolio. Main two reasons. One is that we can get income tax relief on any contributions that we make, whether they are regular contributions or lump sums. So if you think about it, you can actually get £100 invested in your pension for a cost of £55, for example, if you're an additional rate taxpayer. Um, Also, within the pension fund, your money grows tax free. So you've got no liability to income tax or capital gains tax on the growth within the fund. However, HMRC will catch us in the end. We will end up paying income tax on our pensions income. The next one, ISAs. Uh, it's interesting following the budget because pensions are now become part of our estate for inheritance tax. And some people are actually taking money out of pensions and putting them into ISAs. Reason being, they can get tax-free growth on the money, the same as a pension, but actually they can draw a tax-free income from their ISAs. Now we can actually put up to £20,000 each year into an ISA, husband and wife, 40,000. Do that over a 5-year period, there's suddenly 200,000 invested in a tax efficient environment. And the third area there, VCTs, um, I've put it on there because it is a very tax efficient vehicle. We can get 30% income tax on any contribution we make, plus tax-free growth, plus tax-free dividend income. But what I would say is that VCTs, compared to the other two, are deemed to be a higher risk investment. And the reason being that they actually invest in small and medium size, high growth potential businesses. The high growth also comes with an element of risk. So they tend to be higher risk than, shall we say, traditional stock market related investments. So other than your property, if you have other assets, whether it's savings in the bank or other forms of investments, you might want to review those and just make sure they're being as tax efficient as possible for you. Bottom line being, because the less money you pay in tax, the faster your fund will grow. Moving on to the second one, capital gains tax. Well, the budget made no difference there for landlords because second or buy-to-let properties, the capital gains tax rate is still 24%. Remembering, of course, that this applies on the profit or the gain that you make, which is, of course, the difference between what you buy a property for and what you sell it for. Now, you can actually offset a number of expenses, including legal and other costs of acquisition and indeed sale, and any significant improvements. But the baseline remains the same, 24% of the profit when you sell the property. Other assets, well, for example, maybe a share portfolio, we will pay capital gains tax depending on our tax status. If we are a basic rate income taxpayer, it'll be 18%, and a higher rate taxpayer, it'll be 24%. Yeah, obviously, capital gains tax doesn't apply to our main residence, although there was talk pre-budget that that could creep in. Thankfully, it hasn't. So those are the rates for capital gains tax as we stand. What can we do about it? Well, if it's property related, there's not a huge amount we could do. There are things that can be done specific to your circumstances. If you are, for example, a more mature landlord approaching retirement age, first option really is to retain that asset. There will, sorry, by retaining that asset, when you eventually pass away and pass that asset on to your children, for example, the the good news in this situation is that the capital gains tax liability dies with us. So that's one reason for holding on to the property, to avoid capital gains tax and pass it on free of that tax. Second option, you could consider putting a property into a trust. It's ideally maybe suited to smaller properties up to around 325, 350, which is not necessarily the most favorable. But the reason being is that up to that kind of figure, we don't end up paying what's called a chargeable lifetime transfer tax, which otherwise would cost us 20%. The other thing is that if it is a relatively low priced or valued property, let's say the 325, 350 mark, if it does go into a trust, that you can benefit from what's called rollover relief. And this means you don't have to pay capital gains tax on entry to the trust. Eventually it will be payable, um, but um, but not initially. So it's just deferring the capital gains tax, really. Now, why might you say, well, why would I bother? If you did put a property into trust, the real benefit here is it'll save inheritance tax after it's been in there for 7 years. So that's worthwhile considering. And the third option there is if you do decide to sell a property and you've made a gain, yes, you'll end up paying 24% on the gain, but there are ways of mitigating that gain, the capital gains tax, by taking the money from the sales proceeds, particularly the gain or the profit on the property, and reinvesting that into tax efficient investments. In this case, the example I've given is an enterprise investment scheme. If you do so, there's a number of tax breaks. A, we can reclaim the capital gains tax. B, we can reclaim up to 30% of income tax. And C, it'll be inheritance tax free after 2 years. So enterprise investment schemes are probably one of the most tax efficient vehicles we have available in the UK. But again, a little bit like VCTs, there is an element of risk. Now, these are government-backed schemes, by the way, and the government introduced them because they want to encourage investment into small and medium-sized businesses, and that's why they give the very generous tax breaks. Moving on, second area of capital gains tax planning, non-property related again. So if you have money invested or money in the bank, ways to mitigate capital gains tax include, again, the use of pensions and ISAs, as we touched on earlier. There are also things called investment bonds where we don't pay any capital gains tax, and a kind of a whole range of different tax efficient investments where we can not only avoid capital gains tax, we can avoid income tax and potentially inheritance tax too. But for all of those four products, there is no liability to capital gains tax. So again, if you have money outside of property, these are the areas that you should be looking at. The next section is about inheritance tax. Probably the UK's most hated tax. Obviously, we pay tax throughout our working lives. We pay it on our savings. We pay it on our pensions. And of course, the two certainties in life, death and taxes. So inheritance tax, not very popular. This is how it works. First of all, of course, as you're probably aware, we've got a nil rate band. And the nil rate band is the tax-free allowance that we each have when passing on our estate to our beneficiaries. One of the things that I should say here, by the way, inheritance tax only applies if you think about a married couple. There's no inheritance tax between spouses. So, for example, if a husband dies, there's no inheritance tax when the wife inherits the estate. The inheritance tax actually only applies upon second death and when the assets move to obviously the next line, the next generation. So we all have this nil rate band of 325. If we own our own property, our main residence, we also qualify the residence nil rate band of 175,000. Therefore, individually, we have £500,000 worth of inheritance tax allowance. Double that up for married couple. And then depending on whether you're single or married, whether you've got 500,000 allowance or 1 million, any assets that you own and when they look at the total value of your estate upon death, anything over and above your allowance will be subject to 40% tax. Um, so so that's just a brief reminder on the nil rate bands and the tax. And now we'll move on to what we can do about it. Again, property related. Of course, you can do nothing, take no action, retain ownership. The benefit, as we discussed earlier, is that when that property asset passes to your children, there'll be no capital gains tax, but there will be the inheritance tax. And again, depending on your circumstances, depending on the level of gain on your property or the profit, in some cases, we would need to evaluate whether it's better to pay the capital gains tax or indeed just allow your beneficiaries to pay inheritance tax. As we mentioned earlier, you can make gifts or put property into trusts. Both take 7 years to fall outside of your estate. So literally, if you gift a property today and you survive a 7-year period, then it would be outside of your estate for inheritance tax purposes, and therefore that 40% tax would not apply. And finally, although it doesn't mitigate the inheritance tax bill, you can actually take out a life assurance policy. So, for example, if you know that the total value of your estate is 1.5 million, you've got a £500,000 exposure to inheritance tax, and at 40%, that's £300,000 tax bill for your children. What you could do is set a life policy in place for £300,000 so that eventually, when the time comes and we do pass on, the life policy will actually cover the cost of the inheritance tax bill. And then next, for again, non-property related assets. So this is your pensions, savings, investments, etc. Again, you can retain ownership and accept that your beneficiaries will pay the tax bill. In fact, all 4 of these first bullet points are exactly the same as the previous slide. So all options are still again on the table for non-property related assets. And finally, again, if it's cash, savings, or investments that you've got, you might want to consider reviewing them and considering other more tax efficient investment options to mitigate inheritance tax. And so we can look at really all of these options and tailor them to your situation. Just the last couple of slides. As part of Charles David Casson, we are offering all clients a free tax review service. This is an online consultation in which we would review your personal situation, what you're looking to achieve, what your exposure to tax is, and answer any questions that you've got. Then my role really will be to identify the angles and the opportunities that are unique to your situation and where you can potentially save tax, and sort of highlight those opportunities to you and begin to explore your options. In terms of the process, to keep things simple, we've developed an online questionnaire so you can complete the questionnaire. I will then receive that and review it, and then we can arrange a tax consultation, again, typically online. And beyond that, when I have an understanding of your circumstances and needs, you understand also where the tax saving opportunities are, and we've explored the various options. My job would be then to basically build solutions and consult with you and provide advice. And that's a chargeable service. I mentioned that the online consultation, the free tax review, is free. But if you want to do it on an in-person basis and a face-to-face meeting, that's fine. There is a cost attached to that, just to cover really the extra time involved in travel. So that's 150. As I mentioned earlier, tax and financial planning go hand in hand. Depending on any other assets you have outside of property, you might want to review them just to make sure you've got all of your money in the right places and doing the right things for you, that you're getting the growth on your assets, that you're not paying too much in charges and costs, because that will affect performance, of course, and the growth of your funds. Look at the contract terms that you might have in place, whether that's pensions. Make sure you've got the ability to draw those pensions, for example, in the way that best suits your circumstances. A very simple example there is something called Flexi Access Drawdown, which allows you to take your pensions how you want and when you want. That's pretty much it. And obviously, maximizing tax efficiency. I hope that has been useful. Again, thank you for your time. If there are any questions, please feel free to add them to the chat box. The final slide is my contact details. So if you do want to have a chat, feel free to give me a call or drop me an email, and we'll arrange that free consultation. Thank you. Back to Neil.
Oh, brilliant. Thank you, John. Just one thing, I think someone's put in, there's a Q&A section that says the chat's not working, or it's not allowing people to put stuff in the chat. So if you do have any questions, then please feel free. I presume you've got a Q&A button somewhere on your screen, because a couple of people have, someone said this is really good and someone else has said they can't use the chat function. So yeah, if you have got any questions, I'm sure we've got a few minutes where we can answer them, but just look for the Q&A section and pop them in there. Otherwise, obviously, please do take a screenshot of John's contact details, and you can also contact me. It's neil@charlesdavidcasson.co.uk. So yeah, if you have got any questions and you want to follow up on any specific thing that we've spoken about tonight, whether that be to do with your rental property or your sort of tax and financial planning, etc., which is John's area of expertise, then just get in direct touch with one of us. Thank you very much for taking your time out. Hope we haven't disturbed too many of your dinners. And it's a bit weird talking just to a slideshow, to be honest. So we can't see anybody's face. So hopefully there's a few smiles out there and there's a bit of interest. But yeah, we'll be hosting these regularly in the new year as well.
Sorry, Neil, to interrupt. I've
Go on,
just
John.
seen that James Ewart has put something into the Q&A, and he's asked whether the presentation will be available later.
Yeah, absolutely. So we are. So I'm going to click answer this live. Let's see what happens. So basically, we will be. This is recorded, and we will send it out to all the people that have actually attended the webinar, so that you've got it to refer back to. So yes, it will be available later. So yeah, I guess unless there's any other questions, we'll let you all get on with your evening. Once again, thank you very much from me. Thank you from John. Thank you to John for giving up his time as well this evening to come on and talk to us. Thought that was really useful. And yeah, we'll look forward to seeing you all in the future. Thank you very much.
Thank you. Bye-bye.